I'm not going to be able to stand in one place, so better give me something to talk into. Who's got the... Anyway, I have a complaint. Where's Phil? Oh, there he is. He's hiding. So he listed Steve's accomplishments, and on the very bottom he put GRS, and he kind of blew it off. And that is one of the most important things in asset pricing, in terms of it's the primary tool used in time series tests of asset pricing models. I use it on a daily basis. And Ken French and I take a big role in popularizing that thing. So now everybody uses it pretty much on a daily basis. It's almost as important as Fama and Macbeth. That was a joke. Okay, yeah, right.
Either the one on
No,
your hand or the
I
other.
may want to use this stuff, no? Okay, so in the 1980s, I, believe it or not, wrote some papers on money and banking. And at that time, nobody thought the Fed had any power. And one of the little plots I'll put up will show you exactly why that's true. But what happened was macroeconomics got very mathematical. That's not my particular bag. So I went off and went back to finance. And then 30 years later, I looked, and it looked to me like the invasion of the body snatchers in macroeconomics. Everybody talks about the Fed as having infinite power over interest rates, lending, everything else. So I said, let me do some simple tests to see how much power they actually have. And this goes right through the empirical work in macroeconomics. The typical model is a VAR in which the influence of the Fed is taken to be the fact that interest rates lead real activity. Well, we knew in the early 80s that interest rates lead real activity, but we thought that was the market working, not the Fed working. So anyway, that's what I'm going to talk about here. Does the Fed control interest rates? This is a paper that was published a couple of years ago. Here's the picture. This is the target federal funds rate is TF. And this is the difference between the 1-month commercial paper rate and the target federal funds rate. Now, what I emphasize out of this is how different the two can be. This is the shortest rate I can put up there. It's below for long periods of time. It's above for long periods of time. And look at the units here. So this is 1%. This is minus 1%. So even at the very short end, there's lots of variation in interest rates that have nothing to do with the Fed. Here's a slightly longer rate. This is the 3- and 6-month T-bill rates. Those clearly take long swings away from the target federal funds rate. All of those swings have nothing to do with anything the Fed is talking about. I wrote papers in the 70s that basically say, once you get out beyond a month, all the variation in interest rates is term premiums, not forecasts of future spot rates. Here are 5- and 10-year government bonds. They have almost nothing to do with the Fed's target rate. And these are long swings. Doesn't go. Okay. These are very long autocorrelated swings that it takes away from the. Okay, but if you plot the level of the rates, what you see is they are pretty much on top of each other. So this is the commercial paper rate, the 6-month T-bill rate, and the target federal funds rate. So you see they differ for long periods of time, but the general levels of rates are quite similar. Now this is the reason why in the 80s, whoops, what happens to the years here? Okay. Huh. This is the 80s back here, and this is 2008. This is back in the 80s. This is the reason nobody thought the Fed had any power. Why would the Fed let interest rates be wandering between 8 and 12%? Inflation rates were double digit. Interest rates were very high following inflation. Most of this variation is inflation. Okay, I'm sorry. Most of that variation is inflation. And nobody at that time thought the Fed was controlling. Their job was to control inflation. They clearly weren't doing that. Okay, but the issue here is these rates do follow each other. So is it an active Fed that's causing it, or is the Fed just reacting to the level of rates? So I tried to do a series of tests that distinguish between those two things. So that's the question. Does TF move open market rates or follow open market rates? To what extent is the Fed active rather than passive? So what I did was some simple regressions. So we're looking at the changes in the target federal funds rate, okay? So the periods here are chosen because in 1994, the Fed starts announcing its target. Prior to that, you had to infer it from what it said in relation to its open market meetings. So what you're looking at is the day before they change the target rate. This is the difference between the commercial paper rate and the lagged target federal funds rate. So before the change. This is the difference in interest rates before the change. So what we're regressing on the left-hand side is the change in the target federal funds rate. So the issue is, does the target federal funds rate move based on the difference between the open market commercial paper rate and the lagged federal funds rate? Well, if you go down to this period where you really know that they announced the change, what you see is it's adapting 100% to the lagged commercial paper rate. All the movement is toward the lagged federal funds rate, the lagged commercial paper rate. This is the R squared of that regression. 83% of the variance comes about because the Fed is adjusting the rate to the lagged commercial rate. Now, these are just regressions that use successively longer maturities. So you see longer rates have much less influence on what they do. So it seems to me the Fed is adjusting the target rate to the lagged interest rate. Now, what do the body snatchers think? What the body snatchers think is that the market's forecasting what the Fed's going to do. And so the rate adjusts in advance to the Fed's actions. Well, that's the problem. A story can always be told in two ways. Mine is the simple-minded way of reading the data. I think it works, actually. Okay, so the next question is, suppose we look at unexpected part of the change in the target rate. Do interest rates adjust to that? Okay, so how are you going to measure the unexpected part in the rate? Take the difference between the changed rate, TFT. T is the day it changes. This is the commercial paper rate on the previous day. So that difference is a measure of the unexpected part of the rate. So again, this period is the cleanest period down here. During this period is when the Fed is actually announcing the changes in its rate. And this is the regression of the change in the commercial paper rate on the day of the announcement, the next day, the following day, 3 days, 4 days. Is it adjusting to that spread? Well, it clearly is. I mean, the sum of these is pretty close to 1. So the commercial paper rate is adjusting to the difference between the lagged commercial paper rate and the new federal funds rate. The problem is, this is only 17% of the variance of the change in the target. The other 83% is coming from the adjustment to the commercial paper rate. And if I go out a little bit now, the adjustment gets weaker and weaker. So, this is the adjustment of the 3-month rate. Okay, that's somewhat less than 1 if I add these up. If I go to the 6-month rate, less yet. If I look at the 5-year and 10-year adjustments, almost nothing. They basically ignore it. Okay. So it seems to me that whatever control the Fed has over rates, it's very limited. It's at best 17% of the variance of the very short rates and almost nothing on long rates. Now, you have to remember that macroeconomics is has almost not broken out of its mold in which everything takes place in a world of perfect certainty. That's why they talk about the interest rate in the first place. We who grew up in finance say, who cares about the short rate? That's almost nothing in the cost of capital. The cost of capital is more determined by risk premiums than by the short rate. So all of this is basically moot to begin with. How important is the risk-free short rate for real activity? I read the theory of finance as saying, not very important. Okay, Steve said this. The Fed has been keeping interest rates low since 2008. What has the Fed been doing since 2008? In 2008, what the Fed did was it said, I'm going to start this QE business in which I'm going to issue reserves and I'm going to use them to buy long-term paper, mortgages, government bonds, everything. I want to bring down the long rate. Okay, but I realized that if I issue all these reserves and I don't pay interest on the reserves, we're going to have a hyperinflation. So what it begins to do is pay interest on reserves. And it pays interest that's slightly above the market rate. So as a consequence, the banks just sit on them. So now there are $3 trillion worth of reserves against about $50 billion of required reserves. So keeping the rate, here's how I keep the rate down. I issue $3 trillion worth of short-term reserves that pay full interest. What effect should that have on the short rate? You can't do both. You can't keep the short rate down and push down the long rate. You can only do one end or the other. What you do on one end should have the opposite effect on the other end. In fact, the interest rate stayed low. The short rate stayed near zero. And the overnight rate is still, what is it, around 12 basis points? Something like that. And they're paying 25. So she's been saying, we're going to raise rates. I respond, let me see you do it. I don't think they can do it. How would they do it? They could do it by saying, okay, I'm going to pay, instead of 25 basis points on reserves, I'm going to pay 100 basis points. And I'll take everything you give me at 100 basis points. My guess is they get an infinite quantity of stuff at that rate. The other one is it says, no, we're not going to give you anything. We're just going to pay 1% on reserves. And we'll let the banks fight it out. Now, what effect is that going to have? That's kind of an interesting game right there. Does the open market rate just get disjoined from the federal funds rate? I mean, I'd like to see that game played. I think that would be the ultimate out-of-sample test of their power. I think she's hesitating because she realizes she can't raise the rate. Okay. This part of it, I mean, the regressions and everything, they're nice. But this is really the part that really shows you they can't control the rates. Or another part of it is, okay, so there's a paper by, what effect did they have on the long rate? Well, there's a paper by Krishnamurthy and Vissing Jorgensen. First version of the paper said, well, they had a little effect. Second version of the paper said, nah, they never had any effect on the long rate. And the reality is, if you look at the term structures across the world for risk-free securities, they look pretty much the same. And central banks have been doing vastly different things. The European Central Bank is now getting into the QE game. Predictably, that'll have no effect on anything. Okay, so here's the other part. Was there ever a lending channel? So this is the other source of central bank control over the economy, controlling lending through reserves, basically. Through reserves. Okay, let's see how well that works. Now, this is a long paper. It has regressions. I'm not going to show you the regressions. So the pictures tell the whole story. So here are the three components of bank assets. The bottom, this is reserves. So you can see reserves start out really high. These numbers just didn't. Oh, wait a minute. I sent this over. This got destroyed in the translation. This is German. So this time period is going back into the 80s again, right up to pretty much last year. So if you go, this goes back to the 50s. This is 1952 over here. So what you see in 1952, these are traded assets that banks hold. Now, they have no comparative advantage in holding traded assets. That's a zero net present value project as far as banks are concerned. They were holding lots of them here. This is coming out of the Korean War. And there was lots of government bonds out there. So they were holding lots of them. And as the time passes, the loans go up. They're around 70. Loans are business loans, mortgages, and consumer credit. So they go up to about 70% of assets. But even the traded assets basically, they're around 30% forever. Now, why are they holding these traded assets? They're holding them as a hedge against things that the Fed's going to do. Because they can always sell these things if the Fed restricts access to reserves. They can use those. Where they make their money is on these things. That's where they have a comparative advantage. That's the Diamond Dig story, basically. That's where the banks make their money, is on these things. They don't want to be constrained in doing that when they have profit opportunities. And this stuff lets them do that. On the asset side, what does the liability side look like? What happens? These are deposits subject to reserve requirements. Oh boy. Pardon me? Yeah, this is 52. This is 1. The number at the top is 1. This was not the state in which I transported this to this country. Huh?
You do this on a Mac, and that's
I did this on a no. DFA did this, and I looked at it on both machines to make sure it was working in the U.S. I don't know. So this is 100. This number. This number here is like 50. No, wait a minute. Yeah. That is the day when they dropped the reserve requirements on large CDs and CDs. This is small CDs. This is big CDs. But this number, I can tell you what this is terrible. 50 years in the business, and I can't even. This is. Oh, okay. What good is that, though? Okay, I'll hold it up. Okay, but at least I know the numbers, okay? So it did print, it just didn't. Oh, I know. There's a bug in the Deutsche Bank front page. The front page was not on there, so that's when all of this got lost. In any case, that's 1 up top, and this is 30% over here. This is 1. This is 30%. Oh, okay, sorry. Okay, so what's the point here? The point is that deposits subject to reserve requirements, this number down here is 10%. 10% of bank assets are subject to reserve requirements. How much of the total lending in the U.S. economy is done by banks? Not even half. Not even half. I submitted this paper to a journal, and they said, this stuff is, the regressions show clearly that there's all kinds of substitution taking place on the liability side and on the asset side. And the referee said, this is all endogenous. And I said, yeah, that's the whole point. But that doesn't work anymore. Okay.
that was okay. We're going to take a few questions.
Okay, sure.
So maybe I can start with one question.
Okay.
So in these regressions that you showed us, it becomes apparent that the Fed does not control the interest rates, right? But does it? Because you said that most of the variance is coming from somewhere else, and it's not explained.
Coming from the private sector, right?
Yeah. But does it? Can you say it doesn't control anything? So is it just the impact is zero, or is it maybe
at the very short end? It's accounting for about 17% of the variance of the change in the short rate on the days after there's a change in the target federal funds rate.
But maybe this is sufficient for the policymakers.
Well, but then it peters out quickly. 3-month bills is much less.
Yeah.
6-month bills is much less. How important is the 1-month commercial paper rate?
Okay. Okay, so can we take some questions, Christian?
So, Gene, when you
Take a microphone, the room is too large.
Gene, when you regressed it on the lagged interest rate, one of the things that I was wondering about is to what extent the Fed does a lot of sort of messaging before they actually change the interest rates, right? And so one of the things that I think is
They do
difficult-
now. They didn't do it before.
Oh, okay, so then that I think makes that channel, because otherwise I'd be
They
worried.
never even announced the change in the target until 1994.
Okay,
Now they do all kinds of talk.
right, which now makes it very hard to run that regression,
Well,
right?
they've only been talking since 2008. There hasn't been a change in the target since then. It's been the same during that whole period.
Are there other questions at the moment on this presentation? Okay, yeah, there's one.
So you're saying that Volcker did not kill inflation in the 70s and 80s?
Oh, no, look, the Fed in principle can control inflation. My view is that's their only job, but, that's their most important job. They can't both control inflation and control the real interest rate and control employment. They can at best control inflation. That would in principle be an easy job in a world where you had reserves that were paying less than market interest. The inflation rate today is what it is. It has nothing to do with the Fed. It has nothing to do with the Fed. The reason is the Fed does not control any quantity for which there is an opportunity cost. So that quantity before 2008 was the monetary base, which is reserves plus currency. That wasn't paying any interest. It had an opportunity cost. Control that, you control inflation. But now reserves are paying interest at above market rates, and reserves are exchangeable for currency on demand. So inflation is what it is. It has nothing to do with the Fed.
Okay, so thank you. So I think we